So welcome to this latest edition of the Sharesify Talks Shares podcast. And I am joined today by my good friend and Sharesify colleague, James Crux. Hello, James. How are you?
Hey, Steve. Very well. How are you?
I'm not so bad, thank you very much. It's certainly been a busy old week on the markets, that's for sure. The big talking point, of course, is about Capex. Not the most exciting topic, but big tech earnings completely overshadowed by their massive ambitions to flood their AI investments with billions and billions of capital. Now, this latest event was triggered by Thursday's after-hours announcement from Amazon that it plans to spend up to $200 billion this year on AI investment. That's obviously a day after Google said it plans to spend about $185 billion on its own AI plans. Altogether, I've done some back of notebook calculations. I reckon that you're looking at the top sort of half dozen or so companies spending big on AI this year will look to spend somewhere in the region of $700 billion on AI investment. Now, that's an enormous chunk of change. And a key question, of course, the reason why investors are getting very nervous is they just don't see a clear pathway to return on that investment. So that's the big question going forward. Earnings generally very robust, but these big questions about AI. So that's what's been dominating the market mood. We see, obviously, the FTSE 100 is not very tech heavy, so it's done all right this week. It's up about 1%. S&P down about 2%. Nasdaq down about 4%. So obviously that's still with Friday's trading session to come. But talking about the market mood, we've had UK banks as well taking a bit of a pounding. It's not entirely clear why that should be, but ultimately that's what's really dragged on FTSE's performance a bit, and also miners, where gold prices, copper prices, and the silver price have really been all over the gaff. Yes. Now, I know, James, that you've been looking at a few different companies and some big news today from a big European company, Stellantis. Why don't you talk to us about the car dealer, car builder?
Yeah, talking about big numbers. So Stellantis, they've closed a 22 billion charge from the, they've overestimated the pace of the transition to EVs. So that's going to involve a big restructuring. Lots of red ink in last year's numbers. And as a result, they're going to cut the dividend, suspend the dividend, and they're going to do a bond issue as well to try and shore up the balance sheet. So it's a bit of a dog's dinner on Stellantis.
I mean, suspending the dividend is never a great bit of news, is it? But I mean, a 22 billion write-off, that's enormous.
Indeed. So it's all the brands like Peugeot, Chrysler in the US, Fiat, and Alfa Romeo. And obviously, this isn't going down well with investors, and the sentiment towards the stock is poor. And that's reflected in a single-digit PE, which suggests investors don't have much confidence in the turnaround or the balance sheet. So that's a. I mean,
it's always been the big question for the incumbent car makers is about how they transition to an EV world down the line, and the massive capex they put in place to build internal combustion engine vehicles. It's not a click your fingers and suddenly we can just churn out thousands of EVs. It's a huge capital investment, isn't it?
That's right, absolutely. And talking about huge numbers, so Eli Lilly, which is the pharmaceutical firm, that's knocking around the 1 trillion market cap level again this week. It seems to be winning that weight loss drugs war with Novo Nordisk. They've put out sort of contrasting updates where Lilly's raising guidance, Nordisk is kind of put a downbeat outlook out, and due to sort of cutting prices for its weight loss drugs. So there's a real contrast, a gap widening between those two stocks.
So I mean, that's interesting, isn't it? Because I mean, they've both been in the news for 2 years or so now, really based on their relative weight loss treatments, and yet one is really gaining market cap weight and one is really losing market cap weight. But it's counterintuitive because, unlike people, it's not good to lose market cap weight. Obviously,
it's not good to shed those pounds. Definitely not. Yeah, and that, obviously our colleague Ian's put some stories up on the Sharesify site, so readers should go and look at those in a bit more detail. And
a good point, James. And something else I noticed you've flagged. You mentioned about nearly $1 trillion. You mentioned Walmart went over the $1 trillion mark this week, didn't it, as well?
Yeah, that's correct. That's the first ever retailer to hit the 1 trillion barrier, break through the 1 trillion barrier. And that's a lot of testament goes to Doug McMillan, the former CEO, who's now sort of moved aside for John Furman. Yeah, and that's just a staggering achievement when you think sort of Tesco is sub 30 billion market cap. So pounds. So a long way to go. Yeah.
I was reading the other day in a bit of commentary that the founding Walton family, allegedly the richest family in the world. But this, of course, listeners, is not the Waltons like you remember from the TV show. They're not bumpkins up in the Appalachian Hills. This is the Walton family that founded Walmart in the 60s, I think it was, and the richest family in the world, allegedly.
Indeed. And next week, another big week of earnings. So you've got Coca-Cola. James Quincy, with his last set of results, the market expecting sort of 4% top line growth, 4% EPS growth. So, it's a pretty dependable side performer. Yeah. And also Kraft Heinz, which is where Berkshire Hathaway has got a stake. Right. And that one's looking to do the splits. That's more of a struggling business. Right. So, investors will be very interested to see perhaps what Berkshire decides to do with its stake.
Yeah, I mean, interesting. Coca-Cola and also McDonald's is on the roster as well. I mean, these are generally quite interesting companies in terms of taking the temperature for the US and global consumer and how much spending is going and stuff. So all of those numbers will be quite interesting. You mentioned as well, there's quite an interesting angle from, we talked about this before, but Nick Train, two big company results to look out for next week.
Yeah, that's right. So he's got Unilever and Relx. Obviously, Finsbury Growth and Income, very concentrated trust. So, concentration cuts both ways. When he feels the pain, he really feels it. So, with this week's kind of AI disruption story, all eyes will be on those results and perhaps what Finsbury does with the stakes. Again, I don't know what your thoughts are on perhaps what that disruption impact could be.
Yeah, I mean, it's this is the big issue, I think, with the software side of the industry. It's really unknown. And I remember talking to Stephen Yu, who runs the Blue Whale Growth Fund, disclosed I have a holding in the Blue Whale Growth Fund, but he was talking about loosening their stakes in big software companies about maybe even 2.5 years ago, simply because he couldn't really see a pathway for who was going to win. So he was much more comfortable even back then in going for the infrastructure side of things. So that's why he's a big holder in Nvidia, in Broadcom, companies like that really provide nuts and bolts for the AI transition. And talking about the AI transition, it's some interesting companies to look out for next week as well. Datadog and Vertex, they're both really deeply inset into the data center ecosystem. So they will be interesting to see, because as this Capex comes from your Magnificent Seven companies who'd like to think that your Broadcoms, your Datadogs, your Vertex of this world, your TSMCs, will start picking up extra business. So whether that plays out, we will see in time. A final thing to look out for as well is UK banks. We mentioned about them having a bit of a drag on the FTSE this week. We've got Barclays and NatWest to look out for next week. Okay. So that would be interesting, and we should have Ian back in his chair, so to give us a bit more insight than James and I can give on that particular sector of the market.
Indeed.
So that's pretty much it for the week ahead. I think ultimately. Always send in your emails, suggestions, questions, editorial@sharesify.com. We'd love to hear from you. If you're an investment trust or a company and want to get involved in these podcasts, you're more than welcome. Drop us a line at the same email address. And if you're listening to this podcast directly on the YouTube website, then please remember to click the subscribe to the channel link. That might help us build up a bit of content momentum. So that's it from me. That's it from James. Have a good weekend and see you next time. Take care all.